I'm Vivienne Anderson, and this is Avocado Toast. A mortgage is an instrument given to a lender, allowing them to repossess your collateral if you fail to repay a loan as agreed. But that's a mouthful, so let's unpack it a little bit. Imagine that a friend needs a loan.
Hey man, I need a loan.
Sure, how much do you need?
$10.
I got you, man. Small loans are generally no problem among friends, but imagine if the loan were a little bit larger.
How much do you need? I need $1,000.
Here is where things start to get interesting.
Oh, wow, man. Okay. All right. But if you don't pay me back on time, you gotta give me your mullet.
My mullet? But I love my mullet.
Just pay me back, bro. You got to keep your mullet.
In this situation, Vivienne's mullet, a thing of obvious value, is being used as collateral. As long as Vivienne repays the loan as agreed, she'll get to keep and continue using the mullet. But if she doesn't repay the loan, then she will have to give up the mullet. But what about an even larger loan?
Sure. How much do you need?
$10,000.
Now things are getting even more interesting, and Vivienne may have some more questions.
What do you need $10,000 for? And don't say bail.
I want to buy a curling iron for my mullet.
Nice. How long do you need the money for?
1 year.
I gotta charge you interest.
How much?
10%.
Simple interest?
Compound.
How often?
Daily.
Oh man, is that amortized over the life of the loan, or is there going to be a balloon?
For the life of the loan.
Can I pay points?
Over a year?
Ladies, we're getting into the weeds here.
Sorry.
Sorry.
It's no problem, but we should probably get back on topic.
Do you have anything of value to use as collateral?
Well, I don't have anything worth $10,000.
Plus interest, origination, tax, title, and escrow fees.
But I was thinking, once I buy this curling iron, I will have a really nice curling iron to use as collateral. What do you think?
How exactly would that work?
Well, what I'm thinking is that we can go together when I buy this curling iron. Now you pay for it, and then I will sign a pledge that says if I don't repay you on time, you can take the curling iron back, and then you can sell it to like Crazy Eddie's all-you-can-eat pawn shop and hair salon.
I think you are on to something.
Indeed, Vivienne is onto something. She's offering collateral like she did previously with her mullet, but this time she's proposing to use the item she wishes to purchase as the collateral for the money she wants to purchase it with. This is critically important for major purchases like homes, because most people do not have something that is worth as much as a house to use as collateral. The second thing that Vivienne is onto is that Vivienne gets to keep and use the curling iron during the life of the loan, provided that she continues to make payments as agreed. This is important as a lot of people, even people who think they know better, mistakenly believe that having a mortgage means that the bank owns my house, which is, honestly, not even vaguely how a mortgage works. In fact, you give the bank a mortgage. What the bank gives you in return is a loan. What the bank owns is your loan, literally the debt, and the ability to take your house if you don't repay that debt. But you own the house, and you also owe the bank a wheelbarrow full of money. And if you don't repay the money, the bank can take ownership of your house and kick you out and resell it to recoup their costs. Simple, right? This is one of the things that the game Monopoly gets right. If you own, say, Marvin Gardens, and you run low on petty cash, you can mortgage it for some lesser amount, and you don't lose ownership of the property. You just have to turn the card over. Since you already own the property, this is more like a second mortgage, but that is a topic for a later video. But now I'm getting into the weeds. Let's watch Vivienne and Vivienne talk about an even bigger loan.
Sure. How much do you need?
I need $500,000. Vivienne created a slight breach of etiquette by skipping the $100,000 loan and going right for the throat.
What do you need $500,000 for?
I would love to buy a house.
Yeah, you're gonna need to talk to a legit loan officer about that. By the way, I know a good realtor.
Nah, thanks. I'm going to use my father's brother's cousin's nephew's former roommate from college who works at a fish restaurant and does real estate part time on the side.
That's a great idea.
So let's talk to an actual banker for a second. This is Joe Long, actual banker with Guild Independent Mortgage and semi-professional bro guy.
Hi.
Joe, you're not in your bro guy top. What happened? Did you lose your sponsorship?
They make us wear sleeves to the office.
That's not right. And you're not even wearing your top hat into the office today. How are people supposed to know that you are a legit loan officer if you're not wearing your top hat?
Bookcases, important looking documents, and an incredible repertoire of acronyms.
All right, well, I'm willing to take your word for it. My question for you today is, what is a mortgage?
A mortgage is a borrower's promise to repay. So we don't give you a mortgage, you give us a mortgage, and we give you the money to buy the house. And then you promise to do certain things like keep it in good repair and not build fireworks in the shed and other things that would destroy the collateral. And at the end of paying off the loan, the mortgage goes away and you own the property free and clear.
So that seems easy enough. How is a mortgage different than a loan?
A loan is us giving you the money that you need to purchase your property, and you will make us payments on a monthly basis over a set period of time, and we will collect interest over that time until the loan is paid off.
When someone comes into your office looking for a loan, what sort of things are you looking for from them?
We're looking to make sure that you make enough money to qualify for the house, that you have the down payment from a legitimate source, to make sure that your credit reflects that you've paid your bills responsibly in the past, and we're also making sure that you're buying a property that you can safely reside in and take care of, and that we could resell if something were to go wrong or the loan were to go into default.
Do all loans require a down payment?
Different loans are created to achieve different objectives. So some are here to help first-time homebuyers or people that may not have a down payment, and some are a little bit cheaper or maybe have shorter terms and might require a larger down payment. And then finally, some loans need a down payment to offset the risk of certain lenders because they're looking to make sure that you are as committed with your assets as the bank is.
Do you charge interest?
We do charge interest, and the amount of interest that you repay is determined at the time of lock by the market and what's going on with your loan type, and then by how long you keep the loan in force. So the less time that you spend paying on your loan, the less interest that you pay over time.
Some people think it's unfair to charge interest.
We have to charge interest because that's how we pay for our cubicles and our neatly stocked mini fridges.
Joe, who's the best realtor you know?
Besides Phil Dunphy,
I mean, obviously.
I can tell you for a fact.
Vivienne Anderson.
So yeah, that's pretty much what a mortgage is. Oh, by the way, it's a French word that means death pledge, so you totally want that.